Hey guys, welcome back to the channel. Channel's name is The Covered Caller. My name's Max. How's everybody doing tonight? All right, let's see what's going on. Sorry, this is kind of a late live stream. I have just a few things I want to talk about, and then you guys can get out of here. There's one person here. Thank you so much for being here. I didn't publicize this pre-planned it or anything. All right, we'll look at a few things. So we can look at anything anyone wants to talk about. All right, so let's start with the market and see what the market's doing. Are you guys texting me or is that somebody else? I always have to make sure I'm sharing the screen or something. I'm probably not sharing the screen, am I? Okay, yeah, it's not that. All right, or maybe it is that. I need to get in the middle of No, the screen is being shared. Okay, wonderful. Wonderful, wonderful. S&P, no. Let's look at stock index futures. Man, you got to be kidding me. I have to slow down. There we go. And let's get it on the shorter time frame. It looks like it's down 13 bips or basis points. 13/100%. All right. Well, looks like it's close to the lows for the night now, and it's kind of been trending down. This is a 24-hour chart of the S&P with 30-minute bars. So it looks like it topped Christmas Eve about 6 o'clock. And yeah, the day after Christmas, it couldn't make a new, or it did make a new high and failed. It looked like it opened on a new high. Look at that. That was the trap right there. Those poor people that bought that breakout. Anyway, just grabbing a little liquidity. Boy, they got the liquidity and running back down here. Maybe they'll do the same thing on this low. Who knows? Or one of these, maybe they're doing the same thing on this low right now. Maybe they'll just grab some liquidity and run it back the other way. All right. Well, anyway, that's S&P. Let's check out NQ. Sorry about I just watched my video back. If anyone saw my morning live stream, I just watched it back, and that dog was barking a lot. And then I took a phone call. Sorry about that. Anyway, no dog tonight. I won't take any phone calls. Let's see. All right. So NASDAQ looks, NASDAQ made its high on Christmas Eve. Yeah. Well, no, the day after Christmas. I mean, and it opened and ran a new high and then fell. So we'll see. Right now, they're taking out their recent low, but maybe maybe this is a bear trap, or maybe they'll need to go a little bit lower. There looks like there's a gap right here, which they've already filled. So there's also a gap right in this area. So we'll see. If it goes down lower again, the next probably by the dip area is around 25.5. Somewhere down here. Anyway, all right. Well, I guess Bitcoin's probably going down, right? Yeah. Well, but not that much. It's only down 7 basis points. The chart, well, it's the same deal though. Bitcoin also topped. Bitcoin actually topped on. Well, actually, Bitcoin also ran up Christmas Eve and ran up the day after Christmas and then fell a little bit. But then they made a new high. Bitcoin's kind of going more sideways than the market is. Bitcoin looks more bullish than the market. All right. Who else here? Let's see. What are you guys doing? Where's the darn screen? Hey, William, thanks for being here. Hey, Biker Man, thank you so much for being here. All right. I just want to make sure everything's going all right over here. All right. So I have a few things to talk about. What should we talk about? Let's look at the index buffer report and the diversified divas and that kind of stuff. And then I have an ETF I just found that we can look at called HEDG. Have you guys ever heard of this one? Anyway, we'll take a look at it. All right, but let's look real quick at the diversified divas. Where's the latest copy of it? Let's see. I'm just going to grab a new copy of it really quick. Is the Wi-Fi all right? Am I cutting out? Because I'm having kind of a hard time doing stuff. It's just one of those nights. All right. All right. Diversified divas. Let's see how we did today. Well, we finished. All of them finished down. On my morning update, there was a few of them that were up. But by the end of the day, all the divas were down. Boy, that's not good. Old Blocks was down the hardest, but not too bad, though. I mean, just 1 point. I mean, bad, but I mean, it could be worse, I guess. KYLD was down about half of what Blocks was down, and ULTI was down a little bit less than half of that. And then all ULTY was down a little less than half of that one. ULTI was down 34 basis points. ULTY was the winner of all of them today, only down 10 basis points. I mean, it didn't beat Chippy, and it didn't beat GPTY, but it beat everything else. I mean, it even beat WPay, and this is Alti. You know, anyway, Alti's been doing better lately. Still not for everybody, not for most people, but all right. Anyway, I'm glad to see it did better, but I mean, it's whatever. It does well on down days because of all those puts, and you know it. But anyway, all right. Still, the total return since inception, and this chart starts October 31st, is even we've had a lot of good days where it's outperformed and stuff, but not enough because we're still down almost 18% in the past. What is that? So November, almost 2 months. You know, we're coming up on 2 months. It's a bad 2 months. Down 18%. I mean, because the market didn't have a great 2 months, but the Qs were only off 1.5%. That's in the same amount of time. So yeah, that's pretty bad. The only good news is it's not nearly as bad as Blocks and ULTI. I mean, but yeah, it's pretty rough. Anyway, even KYLD, which is probably the most conservative of the bunch, or maybe QLDY, also got beat up pretty well. Look at QLDY right here, was only down 2.18%. That's darn impressive. When its parent asset was down 1.5, that's really impressive. But KYLD didn't do bad. I mean, it didn't do great either. All right, well, let's go. We never look at the index buffer anymore. Let's go pull up that index buffer. I think it's right over here somewhere. Check out the index buffer. If you guys have any questions, we can talk about it, or we can look at something else. Maybe look at stock tools. Anyway, the market didn't move very much today. Days the market doesn't move. This report isn't all that. It's more useful on days when the market's up big or down big. On kind of sideways days, it's still interesting to look at. Boy, Salty had a heck of a good day. That's a really good day. I really liked it because Salty was up at the same time BITK was up, and BITK is long Bitcoin. So that's a long risk assets play. And Salty was up too, which is a short risk assets play. And somehow they were both up, man. If you could do that all the time, you'd have a great, half of each, and they would offset each other. Anyway, it doesn't work like that. There's lots of days that, or most times, Salty gets murdered, and then, the other one's up, but it's not enough to cover the amount that Salty gets murdered. That's just because there's no free money. But anyway, Salty did a good job today protecting the downside. Look at YMAG was actually up a little bit today. That's impressive. BYLD, whatever. Look, WDT was up. Feet was down, of course. Boy, LFGY was down a point. But yeah, Blocks is just getting beat up lately. I mean, it kind of surprised me the Blocks is getting beat up because really Bitcoin hasn't been doing that. It's kind of stabilized a little bit compared to the broader market, but they probably have some stocks that are getting hurt. All right, well, let's look at the index or the yield max buffer. Look at Palantir down more than the parent asset. Blue line's Palti, or I'm sorry, blue line's the high yield asset and red line's the parent. You definitely, the high yield should not lead on the way down. They do occasionally. Babo's leading on the way down also. It usually looks more like Tesla or AI or Coney, where they go down about half to 3/4 as much as or Murray is the parent, but not always. But the other problem is they don't usually lead on the upside, but occasionally they do. Today, GDXY was up more than its parent, which is GDX. That's really impressive. FIBI was up more than its parent, or was tied with its parent, which is impressive. And then AMZ beat its parent, almost doubled its parent's upside. That's a good job. And then also AMD almost doubled their parent's upside. Misty, look at Misty. Misty beat the parent. That's really impressive. It's not all bad news. It's not all bad news, right? All right. You're good on my, okay, good. Yeah, I was just checking. Okay. Hey, what's up, Starscream 84? I think you may be a first-time commenter, or at least I haven't noticed you in here before. These other guys are in here all the time, like old William and Z Bikerman and William. All right. What do you guys do? Is there anything specific you guys want to look at? I was just talking to a friend of mine about this fund. I thought we could look at it really quick. I just pulled it up. Oh, I know what, but I have something specific that you guys would probably rather talk about. I forgot I had something I wanted to talk about tonight. Who wants to talk about the new, let's just go pull it up. Where is it? This is what I'm excited about. We could talk about that HEDG also. I mean, I'm not excited about it, but I'm really excited about this MAGO from Total Capital. Let's see what it did today. So this is Total Capital Magnificent 7 Income Blast. So I really like the Income Blast strategy. I think this is the first of the line in the Income Blast, but they're doing a special option strategy that I think is going to work. Excuse me. That I think has potential, especially in a bull market, to work well. All right, well, let's see what it did today. I guess it's been out 2 days. Now, those are 30-minute bars. It's hard to tell. It looks like it's still at 25. All right, I can't really tell. Anyway, all right. Well, anyway, so what it is, the Income Blast Magnificent 7. So they're going to just own 7 stocks, and they're going to do option strategies on the stock. And the idea is it's an Income Blast. They're going to do option strategies. The idea is you should get partial upside to the Magnificent 7. So it's a bullish bet on the market, just like every single one of these is, except the inverses, and they're bearish bets on the market. So it's a bullish bet on the market, more specifically the Mag 7. But at the same time, it should pay maybe, I don't know what on income yet. Maybe, I don't know. I mean, we're going to have to, I'll make some content on it soon. I just wanted to show, in case anyone was interested, what I did is I put the trades into the spreadsheet. I thought you guys might want to listen to this. Is Charles around? I thought Charles might like this if he's around tonight. Sometimes he shows up at night. Who knows if he's watching? Oh, okay, Starscream. Yeah, that's cool. I'm glad you're new. I'm glad you knew. Yeah. Was I talking? I forget what the question was about KYLD. Well, anyway, yeah, that's a fund called K Yield. Put the rest of your question out, and I'll get back to it. But let me show you on this MAGO. But I'll answer whatever about K Yield. Okay, so on this MAGO, what I did is I loaded their trades so we could take a look at them. And I didn't want to make a full video, so I just thought we could look at it really quick. I tried to look at it quick today, but it was too complicated. So I just looked at a couple of trades. They do the same thing on every trade. They don't have any stock. They do a 4-leg option position. But two of the options replicate stocks, and then the other 2 options they earn is a put spread, and they earn an income off of. So it's one of these lightning spread strategies. But so what I did is I went ahead and loaded up one of them into here, and I could show you how it works. All right. So All right, so this is a trade they have on, and this is one of the first we could follow this trade. So this is trying to think the best way to show this to you. The red and green line is the profit and loss graph at expiration. We're going to compare it in a second to stock. So, but let me just show you the trade right here is there's 4 options. So there's the options over here that expire in April. So those are probably what, 90 days out, January, February, March, something like that. Is you buy a 270 call, and they did it 4 times. I'll put in how much they actually did. All right, they have on this trade right here. So they bought 4 270 calls. At the same time, they sold 4 270 puts. Now those don't expire till April. I bet you anything they hang on to those for a month or something, and they'll use that as their long. That's going to be the stock, the synthetic stock in this plan. So that trade right there wants the market to go higher. Period. That's all it cares about. Just wants the market, just like stock. Market goes higher, makes money. Market goes lower, loses money. Okay, but then we have then right here they've got on top of that, and this is the key. This is the cool part though. They've sold puts, but they've sold puts like that expire in 10 days or something. So and they sold the 265 put 4 times for $66, and then they bought the 260 put 4 times for $27. Well, the difference between 66 and 27 is whatever it is. What is that? 33, 43, something like 46, 36. I don't know. Whatever it is, they made that much times 4. It may not sound like a lot, but if they can do that every 10 days, it'll add up. And at the same time, they have, if this goes up, they're in business. So let me show you. Let me try to show it a better way. So what I did is I just duplicated the tabs. So we have one tab with the trade they did. So I duplicated it, and I think maybe this will explain it better. I'm going to just peel everything back one leg at a time. So let's take off. We'll take off the put spread. Okay, and so that's where we just have a long synthetic. We could actually just compare it with that. So I mean, or this is half the trade. This right here is just synthetic, and this right here gives you the same exact return as stock. This white line that's left behind is the return that the trade gives you. So, in a big loss, you could see the white line. If you lose more than about 3.5, 3.6%, the white line, which is the trade, which is this over here, this is the lightning spread. This is the lightning bolt. The bolt stings you. The bolt strikes you. If you run through the strike, you get struck by the bolt. Well, and you have a double loss right here between 265 and 260. You lose a double the rate. Well, anyway, that's the risk in the trade. And you can see that realized if, the only way this trade loses is in a market that drops more than 3.5%. Other than that, it's just like having stock. You just want the market to go up. But here's the kicker. It's like having stock, but these options they sell expire, every week or something, every week or two. So they do that over and over again, but these options they buy don't expire for 100 days or something. I bet they keep these on for a month or two, and then they'll roll out to maybe the June. They'll keep these Aprils on, or maybe for 3 months. Then they'll roll out to the Julys. Nothing, but every 2 weeks they'll sell whatever is the short-term option against it. And so at the same time, they'll bring in an income, and they'll pay the dividend with the money from the short-term option. But at the same time, if things work out and the market goes up, you should have the same upside of stock plus the dividend. And that's the lightning spread. That's why I'm really excited about this. I don't know how much it'll pay. But anyway, so here's the trade they have on. So, here's the other thing. They don't have to hold it till expiration. If before expiration, it's almost the same as before expiration, if they just hold it like a few days, it's basically, that's basically the same as stock. There is a little bit of an extra loss there, but not a huge one. I mean, it's basically the same as stock. So, and I'm excited about this one. It's not free money. And if the market goes down big, it's going to have a little bit of an extra loss because of this put spread. But anyway, you guys anyone in here going to get that? I'm excited about that. I think, did I run it through the back? Oh yeah, I did run it through the back tester. I have something else to show you. Well, you guys probably don't want to look at the back tester. But I back tested in the back test really well also. Hey Marcus, what you doing, bud? Well, I don't know what I said about KYLD, but I'd be happy to try to answer that. Let's look at this HEDG. Ambassador of Quan just shot this to me on a text message, and I just typed it in, and I was just trying to look at it because the screen's broke on my phone. I can't see it on my phone. We can look at it together. Just an interesting idea. It's been done before, but so currently, you guys know we have covered call funds where they're long stock and they sell calls. And then they have funds that are buffer funds where they're long stock and they sell calls, but they use the money from the calls to buy a put to basically lock out the downside. Well, so you can either have locked out downside or you can have an income, but you can't have both. Well, that's until recently. There's other ones out, but this one right here, this one is like a buffer fund. It's part buffer fund. You have exposure to the stock on the long side. This one I think is the S&P. Yeah, it's exactly what it is. But anyway, you have. But this is just a new fund that came out. I'll do some content on it. But this is a thing that's trying to split the difference between a buffer fund. It's trying to cut a lot of the downside off without and still being able to pay you some type of meaningful yield. So we'll see how that works out. Currently, there's one out that you guys have probably heard of. From Simplify, there's one called HEQT and something. I think it does something else. And I think it pays a yield. I don't know. HEQT may not pay a yield. Anyway, there's funds that are trying to do this. Anyway, this HEDG does look interesting. And, but typically the way there's companies out there, there's Innovator and there's Calamos, and there's places out there that have buffer funds, and they sell calls, but they buy puts, and you don't get a yield, but they lock out almost all the downside or a good part of it. But most places either do that strategy or do the covered call strategy, but really not many places have tried to combine the two strategies. But Simplify, I believe. Let's look at this. Let me think of a better way to look at this HEQT. Let's go to FinViz. Yeah, but I believe this HEQT has been out for 6 months or something, and it's a Simplify hedged equity ETF. But I thought it was a hedged equity income ETF where it also paid a yield. I was wrong. It doesn't. It only pays 1%. Simplify has one Calamos has one. There's one out there. Marcus, you know what it's called. I'm sure Marcus put it in the comments. There's one out there that pays a yield and locks out part of your downside. What's it called? I mean, anyway, HEDG is one option. Let's look over here at HEDG. How long has HEDG been around? I couldn't really tell from the other chart. Okay, it's been around for a little while. It's paid one. It looks like it paid a quarterly dividend. Look at that. It paid a special dividend of 35 cents just a few days ago. That's not bad. But it's a $26 stock, and to get 35 cents for a quarter is pretty bad. So yeah, that's not what I was thinking of. Anyway, there's some funds out there that pay a yield and give you a hedged downside. Besides this HEDG, I'm just drawing a blank on I'm just trying to blank on what it's called. Yeah, have you seen that one yet? Hey, Brad, what's up, bud? Have you seen that one yet? It does look interesting. Yeah, it does. I didn't think about that. The chart does look like T-Oak with the dividend. Correct. SBAR has a 30% barrier. One thing you have to be aware of is the Russell drops or S&P. Yeah, I know it. Those. I mean, yeah. Okay, I'm going to switch lanes into a different subject. Because now let's go over to barrier funds, and I'm going to jump the track again from barrier funds to auto callables, but it's a similar concept. CAIE and CAIQ. Marcus knows a lot about CAIE. Skeptic does. I forgot about CAIQ. It's newer. It's been out like a month or two. How's it doing, I wonder? Anyway, I saw some content on it today from somebody that I like. I don't forget who the influencer was. I'm not trying to put him on blast, but I think he said something that was wrong, and he gets a lot of views. I even thought about making a video to correct it, not to be mean or whatever, but I want to see if I'm right. I want to see if you've seen it too, Mark. It was somebody that I like. It was Dividend Bull, and I like his content. He has good content, great graphics, he's well spoken. I enjoy his content, but he said something I disagreed with, and I think he's wrong about it. I don't think he means to be, but let me run this by you, Marcus, if you're listening. Yeah, I agree, Brad. Okay. He said on the auto callables, and he was talking about CAIQ in this case. He said they have 52 auto callables. It has 40%. He was just selling it as a 40% buffer. He doesn't explain it nearly as well as you do, Marcus, or didn't explain it as well as I did that one night when I went into it. But he gave a good basic explanation of it. And he said, look, if it's not down 40% in a month, you're fine. That's true. But it can be down 20% one month and 20% the next month, and you aren't fine. So it doesn't right. Anyway. So I think it can't be down more than 40% in a running year, right? Or it can't be down 40% ever from the time that they put the bond on. It depends on where you buy it and stuff. I think that's right. Anyway, and people are probably getting really excited. I don't know if any of you guys saw that video, but I don't think that's right. And you said it 2 or 3 times. But anyway, do you have an opinion on that, Brad? Or it looks like Brad has CAIE and it's been good to him. Gonna add CAIQ. Yeah. Marcus has been trying to get me into CAIE forever, and I've been resistant because I told him I didn't understand it. But I've been kind of coming around. Now I've been watching how it works, and I'm starting to understand it. I mean, I understand the words on the page, but I'm having a hard time conceiving of it, in practice or whatever. It's a product that's never been, I mean, even when I was a stockbroker, we never had access to those. Those have been things that hedge funds use and stuff. I know nothing about those. All I know is about covered calls. All right. Option strategies is my specialty. Okay. Because CAI is laddered with market crash doesn't affect. Okay. True. Okay. No, and I thought of that too. You say but still, I still think it's oversimplified to say it only has to be down 40% in a month. It can be down 30% 1 month and 10%. It probably won't do that either, but it's not just in a 1 month period. But I know what you're saying. They buy a new one every week is what Brad's saying. And I get that. So that you're right. So that specific fund, but that fund, I think each one they buy lasts 2 years though. I think all of those here, let's go look at CAIE. Let's go look at CAIE. Okay, you saw it too, but I'm not trying to put them on blast. I'm just trying to say, I'm just trying to make sure we're all on the same page. I probably won't even make content about it. I just want to make sure we all understand it, and if we don't, let's see, CAIE ETF pros. Usually, if I type Perspective, I'll get the first result that comes up. ETF prospectus, will be what I'm looking for. All right, because it shows the individual bonds. But I thought the maturity on these are 2 years, or no, 5 years. So I think, right? So it can't drop more than 40% anytime in any 5 year period. It has to be over 40% for the entire 5 years from the place it started. I mean, I get that if the market drops, you're going to be putting on new ones as it drops, and they won't get busted too. But I think that's, yeah. Anyway, okay. I just want to make sure we're on the same page about that. Not that these probably aren't the greatest investments ever. I mean, time to maturity, 3.5 years. I guess some of them are different. It's how much time they have left. But no, when they put them on, they have 5 years. So they can't drop more than 40% anytime over the next 5 years from the point that you bought it at. It's not in 1 month. Yeah, it's just, it's not at all in 1 month. They could drop 10% 1 month, 10% the next month, go up 10% the next month, drop 20% that month and 10% the next month. Boom, you're down 40 and you aren't getting paid. Now, it probably won't stay down there. If it's just down there a month and bounces back, you're fine, right? I mean, that's the idea. As long as it bounces, you're fine. But wonder if it's down there a couple of years. I mean, it's maybe I could get AI to look at the past 40 years or something and see how many times that this 40% barrier has been, see if AI can figure out how many times this would have got busted. But it's just over a 5-year time frame. It's nothing for the market to drop 40% at some point in that 5-year time frame. It doesn't mean it's still not a good investment, but I mean, there's no such thing as free money. So, I mean, I always forget about the box spread component. You're right. You're right. And he kind of mentioned that too, because he said that the market makers or the fund also does some options to hedge or whatever. No, and I've seen those in there. I need to take another look at it, I guess. Maybe I need to review CAIQ or something now that I understand a little bit better. Or maybe I need to look at I don't really understand what they're doing with the option part of it, with the box spreads. I mean, I read the words on the page and there it is, box spread. So, but I understand how long puts work. So they're buying a long put. So the thing is, if any point these things don't start paying, their put will be printing and maybe they'll sell their put to offset some of the payment. Yeah. Whatever. I love that. And they weren't doing that at first. That is kind of a new thing. But I don't understand this part about it. I know what a SPY long put is, but I don't understand what a box spread flex option position dash SPY long put is. I mean, I know what a box spread is. I know what a SPY long put is, but I'm not sure. And I know what a flex option is, but I'm not sure I understand why they're all smashed together. I even understand this right here. This is the auto callable, and I don't totally understand that. Well, anyway, but box spread flex option position. Oh, okay. Oh, I got you. They're just doing a flex box spread. I got you. Okay. Yeah, then this is probably safe as heck. All right, I need to get more in the middle of this one. I'm getting more interested now that it has options. If you could find a way to make it work, because if you could, that is interesting. Thanks for reminding me of that, Marcus. I need to. So I have about, I think I have 7 or 8% left. I want to invest it by the end of the year, maybe tomorrow, or 10% in cash right now. I'm not real positive about next year, midterm election year. I haven't liked the market for a long time. It's still been going up, but I mean, at some point it's going to, anyway. So I'm not sure about adding risk, but I'm thinking about putting CAIE on, but I really want Mago. So I'm thinking about half Mago and half CAIE, but then I'm thinking, or CAIQ, whatever. But then I'm thinking, okay, do I really want to put Mago on right here at all-time highs? But I just love the strategy. Anyway, what are people liking XXV since it's a 25% distribution? Yeah, I really haven't got in the middle of that. I've been out of pocket. I'm glad people are liking that. So, yeah. So they're paying 25%. Did I ever figure out what Anacorado was? Or I know we talked about that area. I can't remember. Oh yeah, I forgot, but we did figure it out. We did figure it out. Oh yeah, and we went through these trades too. These all their stuff. Well, I mean, so you have an ETF where the NAV has gone up. Now it's just paid monthly, it looks like, or it's just paid once so far. So it paid 60 cents, but if it keeps that up, is that $7.20 on? Yeah. So that's like, yeah, like 25% or something. Man, that would be awesome. I need to look at this one. I just can't decide. I'm either, I mean, I'm looking at CAIE, CAIQ, or SBAR, or one of the barrier funds is basically the same concept. So I'm thinking if I'm just trying to decide what the cash I want to put to work. If I want to go, just maybe use all barrier funds just because I don't like the way the market looks. And then maybe at the end of the first, I'll try to rebalance every quarter. And then maybe if we do get a drop in the first quarter, and I hope we don't, but if we do, maybe, I don't know. Maybe at that point, take some out of the barrier funds and put some into. I just want some of that Mago though, but Mago won't do well if the market's top. If the market's topped here or something, the market goes down. Market has a bad first quarter. Mago's going to get. Because remember, that's what I showed you guys about the lightning spread. The lightning spread has a negative buffer. Recovered calls have a positive buffer. The white line is on top of the red line, meaning that the option premium gives you a little buffer. This one, just because of the structure with the sold puts, I was trying to illustrate it with the two lines right there. I'm hoping I'm doing a good job. But so that's your cost in this trade. That's your risk is a drop of more than 3%. Because then instead of having a buffer, you get the same loss that stock would have plus a little extra. So Mago would probably be a terrible decision if the market were, if I'm not bullish on the market. So maybe I need to think, but man, I don't know. I love this. I love this strategy, but maybe the wrong time for it though. Anyway, I'll make some content on it or something. Okay. XXXV, what is the barrier? Well, it kind of depends. It's kind of, I'm not sure. It says target 25. So the target means 25 is the distribution. I thought it might be a 25% barrier, but it depends. Okay. This is a little bit in the weeds. I don't know if you just, if you don't understand what I tell you, copy and paste it into AI and ask them to explain it. But these are, or I Googled it or whatever, but this WOF, these are barrier options. So you see where it says cash. Okay, look at underneath that. Coinbase MicroStrategy. So what that is, this is a barrier option. It's on Coinbase and MicroStrategy's WOF. That means worst of feature. So that means the worst of these can't be under, I think, down 50%. The P150, I think that's the barrier amount. This one down here, 60, means it can't be down more than 40%. I think it's the inverse of how much. The 160 means it's a 40% barrier that you don't realize a lot. But anyway, so what it's a bet? It's a bet that either Coinbase or MicroStrategy's, the worst one. Don't worry about the best one. The worst one can't be down more than 50%. And if it is, the barrier's busted, and I forget either. I guess they don't owe you I forget if it works like the auto callables where they just don't have to pay you the payment that month. It's probably what it is. Yeah, barrier options. but here's another one. This one's AMD, Intel, NVIDIA. So the worst of these can't be down more than 40%. EK1 and NC1 mean something too. Like I say, you can go put it into Grok. It'll explain it better than me. But and this tells you the date that expires. So it can't be. So Coinbase MicroStrategies can't drop more than by half between now and November, of next year. AMD, Intel can't drop more than 40% by November of next year. Tesla, no worst of, just Tesla by itself can't drop more than 40%. So they buy individual options, so they're putting on individual barriers, or these are barrier options, or these are all kind of like auto callables. Well, not really, but they're very similar. A barrier option and auto callable have a similar concept. Anyway, but then they have two tranches of this AMD, Intel, and NVIDIA. They like this trade so much, they put it on twice. Now they have two different expiration dates. They went out a longer week on this one, but it still can't drop more than 40%. So that's a way oversimplified explanation of the barrier options. But that's what I think they mean. That's how I read them. I hope that helped. Yeah, it depends. But what does that P100? What does that P100/50 mean? When I thought that meant that anyway. Hey, Whistler, the Calamo strategy is index-based, XXV. Yes, and that's what I was showing you. Those XXVs and it was the worst of feature on it depends. It was doing AMD, Intel, and exactly. And I think they'll probably tranche them in there. So as they get more money in, they'll probably buy more of those, and maybe they'll use other stocks. I mean, I bet you they're building a portfolio as they get more assets. I prefer just the index. It's easy, just the Calamos worst of feature. It's worst of Russell, SPY, and Qs, and the worst of them can't be down more than 40%. Yeah. But anyway, hey, Roxanne, they generate premium income from individual positions. Good. Yes. Good point. Good point. So Calamos is index-based, correct. XXV is based on individual stocks. Individual stocks do generate more premium, higher distribution. Yeah, correct. Yeah, good point, Roxanne. Roxanne, or whatever. The auto callable just can't be adjusted, but they'll grow more in a bull market. That's the only real difference. Yeah, it is a good point, Roxanne. Thank you, Roxanne. I got some new glasses. These are loaner glasses, readers. I can barely, anyway, whatever. All right, guys. I'll be back in the regular studio. I'll get back to my regular content on Friday, or I'll probably be traveling. I'll be back to my regular content on Saturday. So on Saturday, I'm going to get back to my nightly, daily factor shows. I really like those shows and stuff, but I'll get back to the regularly scheduled content. I had over 5,000 people, which is my goal to get there by Christmas. And I did. I got there by Thanksgiving, but then when I've been on vacation, I've been losing people, not back under 5,000 again. It's no big deal, though. Remember, guys, not financial advice, consult a professional advisor. I'd be happy to stand around and shoot the breeze with you guys if you guys have extra questions, but it's getting late. I'm kind of embarrassed that I didn't really have a good answer on the box spread. I swear that's a new thing. When they first came out with this, it was just auto callables. I like the addition of the box spread. I'm going to make some content on it and learn about it some more. All right, guys. Well, thank you so much for being here. I really appreciate you guys. No dog to interrupt us. I didn't take any phone calls. Everything was good. Like I say, not financial advice, and consult a licensed planner. That's all I have for you tonight. Have a good one, and I will talk to you later.